They're calling it Black Monday.
What did he say?
Warren Buffett just offloaded half of his Apple holdings. He just offloaded Bank of America. Nancy Pelosi just got rid of all her Microsoft stock, and the stock market is completely collapsing. This is the biggest dip we've probably seen since 2008.
Yeah, listen. We fucked up.
So what does that mean for you if you're trying to buy a house, thinking of getting into the housing market, or you currently own a house and have debt and are trying to think about whether or not you should refinance, get a HELOC, or you're just in any part of the housing industry? I'm going to give you some general information that you're going to be able to leverage to really make an informed decision and move yourself forward in the best position possible. But before I get into all that, I want to tell you what exactly is going on. The US national debt just rose to $35 trillion. And that's a huge number. You can't even count to that number in a lifetime. So what does that mean though? The average consumer in the United States actually just reached an all-time high, hitting almost $18 trillion in overall debt. 6 of those trillion are consumer debt. But there's one specific class of individuals that are getting impacted the most, and that's the Gen Z, people between the ages of 12 and 27. Now, of course, you can only take credit at the age of 18, so we'll focus on 18 to 27. Their credit affordability, how much credit they get issued, is actually the smallest pool within all the other age cohorts. So for example, on average, a Gen Z individual has about $4,400 in credit allocation, while a baby boomer on average has total credit available to them of $22,000. Now, because the Gen Z person has a smaller pool to access, obviously as they pull more money, their utilization rate increases. And now where it impacts them, if they're trying to buy a house or move forward in life, the higher the credit utilization, the lower the credit score, as opposed to the baby boomer who has the lowest credit utilization. The baby boomer has more access to capital. So if they borrow $4,000 against their $22,000, their credit score is probably not impacted. If anything, it might be impacted to the better because they're still within the 25% range. Now, if the same person, just younger, that Gen Z person borrows $4,000 against their $4,000 credit limit, the banks see them at 100% utilization. And so the FICO algorithms actually lower their credit score significantly because they become higher risk of default. Now, this higher risk of default is actually legit. What we've been able to calculate is that 30% of all the people that take credit are sitting right now between 90 and 100% utilization. That means if you get 10 people in a room, 3 of those people have maxed out credit cards. And why that's scary is because those are the people that are most likely to default. What does all this mean for you, the consumer? If you're looking at getting a house, or you're thinking about getting pre-approved, or you're a person who is in that range and has a house, and you're like, dude, can I tap into that equity? Well, because the utilization rates are so much higher and your credit scores inversely are so much lower, it's gonna make it harder for those people to enter the housing market, giving you a cap on the overall demand. Now, if you have a limited supply of houses, say you have 10 houses, and now in the stable market, you have 10 buyers looking to buy those 10 houses, that's equilibrium. Supply and demand are the same. But now if we eliminate an entire generation, call that 25% of new home buyers, well, we just lost 2.5 people. So we can't lose half a person. So let's just say we lost 3 people. So now we have 7 buyers and there's 10 houses on the market. Well, what's going to happen to those houses? There's a bigger supply than there is demand, and that can cause house prices to drop because they want to make it so that it's more lucrative for the buyer on the other side. Now, I know what you're thinking. There's no supply. And up until a few months ago, you would be right. There is no supply. But supply is increasing ever so greatly. And here where it gets really tricky. So you're going to want to pay attention to this. As credit utilization goes up and people continue to borrow more and more and more money, they start to look at their houses as ATMs and opportunities for them to get money out of their equity to pay off all the debt that they've taken. So for example, if you have a baby boomer who's on Social Security and they've been making $2,000 a month and they've been able to live comfortably off of that, But because prices went up so fast, their property taxes increased, their homeowner's insurance got more expensive, gas got more expensive, food got more expensive, and now those $2,000 just aren't cutting it. So what are they gonna do? Well, if they have $500,000 in equity in their house, they're gonna be calling me to refinance, or they're gonna sell their house. Now, if their credit's shot because they've been using credit to survive and now they maxed out all their credit cards, that's gonna cause them to force a sale rather than refinance or take a HELOC. As we start to see more of these people increase in their credit utilization, lower their credit scores, they're gonna be forced to sell, and all these forced sales are gonna come onto the market, increasing the overall supply. And I believe that if this continues down the trajectory that we've been on, you're gonna have an oversupply of homes, and that's gonna cause a crash in the housing market alongside the overall stock market crash. And I wanna say one last point. This is where it really gets interesting. If the stock market continues to crash and you start to see unemployment go from 4.3% to 5%, and the feds don't react and cut rates fast enough. Now that's key, because the feds will cut rates, but will they do it fast enough to stop a recession? So if unemployment rises and these companies have massive layoffs, all those people who got laid off and already have high credit utilizations, they're going to be forced to sell their home. And again, that's going to add to the overall supply. Now, what's happening as credit utilization goes up and people continue to live off credit and their savings are depleted, demand is dropping. And so as you start to see a dip in demand and an increase in supply, not only is the stock market going to crash, you're going to see a housing collapse, and you're going to see house prices continue to dip in value. And when they dip in value, they dip fast, because a person who's been on the market for 6 months will stay there, and the next seller will see that, they'll undercut that by 20,000, they'll sell their house, and now the next person will have to go under. And it's like walking down the stairs, it'll continue to dip until you reach equilibrium between supply and demand. So finally, if you're thinking about buying a house, here's what you need to look at. Do you have enough reserves to offset your payment for 6 months to a year? And the most valuable tip I can give you, come in with as little money as possible. And the reason why you want to do that is you want to stay liquid. So if you have a $500,000 house that you're thinking of purchasing and you can get in with 20,000, take the higher monthly mortgage, keep all your cash in reserves, and come in with the smallest down payment, so that if the house prices do dip below what you bought it for, you're only risking 20,000 in liquidity. And guys, I know there's a lot of mortgage and real estate professionals on here. I really thank you for choosing me to be able to give you as much information as possible. I promise I'll always come to you direct with no fluff. And so if you like this video, hit the like, subscribe for more content, and comment below what else you'd like to learn about so I can make more videos and add value to you.